Welcome to IG's Trading the Markets podcast. On this week where we have US jobs data, we've just seen the release of the ADP private payrolls number showing 20.2 million private sector jobs having left the economy in April. That is the US number, and it's one of the ugliest numbers in decades. We got non-farm payrolls on Friday. We're expecting another ugly reading for the jobs picture in the US economy. Let's take a look at what this means to the markets now with Nick Corley from Daily FX. Nick, it's great to be able to catch up with you again at Daily FX and take a look at your view on this number out on Friday. I'm really interested, first of all, to get the answer to the question, just how important is this number? We know it's going to be bad. We know it's going to be big. We know it's going to be ugly. How important is it to the market?
Yeah, hi, Jeremy. I think the one thing that you can say is going to be set in the history books, and I doubt if it'll ever be beaten on a negative or a positive way. Non-farm payrolls have always been one of the big drivers, but I think what's actually happened is because of the speed of the job losses that we've seen over the last 4 to 5 weeks, the initial jobless claims filings have been a lot more accurate, a lot more closely followed, and they really give us a very big clue to what is going to be released on Friday. The initial jobless claims, the 4-week rolling average is just over 5 million at the moment. So that's about 20 odd million jobs have been lost in the last month by the initial jobless claims reports. And if you now sort of put this in with this sort of worst ever ADP release that we've just seen, you are still looking at 20, 21, 22 million people leaving their jobs in April on the NFP report.
One of the things about looking at the ADP and then looking at the non-farm payrolls, sometimes there is a read across and sometimes there is a big, wide divergence. Now, that could be for any one of a number of different reasons. Setting aside the reasons necessarily aside, what are the risks to this number on Friday? Is it to the upside or to the downside, or is it just impossible to tell because of the just sheer magnitude of the figures we're talking about?
Yeah, I think the latter. The one thing why people look at ADP and NFP is they're both the sample size for the figures are both done on the same period, which is for this month's reading would be the week commencing April the 12th for that week. So that's their sample size. So the ADP and the NFP have that correlation. It's really difficult to tell. As I said, if you're doing an office sweepstake on this number, you could be a million and a half out and still win the prize. It's just unheard of, really.
I mean, the Federal Reserve has clearly prepared us for a big number. We know that because of the unprecedented amounts of money that the authorities in the US, and of course it's replicated throughout the world, it has to be said, that these authorities are making available to support the devastation which is being caused within the economies around the world because of the coronavirus. If the number is wildly better than expected, or indeed off the other end of the scale in the other direction, how do we expect the markets to react? What should we read through if the number is, as I say, wildly off the scale?
It's a good question. I think the markets, they've priced this in, as I said, because of the initial jobless claims that we've seen over the last few weeks. The US Treasuries, they announced $3 trillion borrowing for the second quarter this year, which is the largest annual borrowing. Well, the largest annual borrowing before was in 2009, which was 1.8 trillion. So unprecedented amounts of money are being borrowed. I don't think that if we get a minus 18 million or a plus 23 million, there's going to have a great deal of difference on the way. If you're looking at the stock markets, it's going to have a great deal of difference on the stock markets. A number below 20 million, you may get slightly more of an uplift. A number slightly, 23 or above million or above, you may have the market weighed on slightly. But the markets aren't really being driven by sort of economic news at the moment. This is all in the background. It's all about the Fed. It's all about the money being thrown in. It's all about people pricing in a sort of second half recovery and growth, fueled by this sort of enormous amounts of stimulus that we've got. And then obviously after that, the coronavirus, sort of the unwind of all the lockdown measures is really where people will be looking at to see when this has happened and when the economy can at least begin to grow again.
What is the dollar telling us then at the moment where it is. We haven't really seen too much of a move away from that 100 level. If you look at the chart, and you've got an opportunity, I know we're only talking here about the audio part of this, but if you were to look at a chart, it's almost something coming to a head. The chart's got this sort of symmetrical triangle that's building up here to around about the 100 point. If there is a good number, do we celebrate that and go into the dollar because of the potential meaning to that in terms of the economy is a little bit better than expected, so the dollar's going to rise? Or if it's a dire number, do we go into the dollar because the dollar is a safe haven?
I think people are going into the dollar anyhow. Any sell-off that you've seen in the dollar, maybe I'm looking at the dollar basket, for example, any sell-off that you've seen sort of just below the 99 level gets bought again. Maybe we're topping out around the 101. So I think you're kind of in a range there. But I think the dollar, for good, for bad, will still remain the ultimate safe haven. And they've announced this $3 trillion Q2 spending package. And that didn't really dent the dollar at all.
From a broader viewpoint, have the markets, in your mind, moved too far?
I think they have, yes. I think as I said, people have been pricing and maybe being overly optimistic that all this nigh on free money is going to make us this V-shaped recovery, that everything's going to be all right in H2. And I mean, this is a kind of line that we're getting fed anyhow. From a lot of Fed officials and from officials in other European countries that, Q2 numbers, GDP numbers are going to be shockers, but Q3 and Q4 are going to, start to upturn. And, 2021, we're going to see a nice recovery. But as I said, I think that's too optimistic. And that's why if you look at maybe some of the markets, if you look at, say, the Dow Jones or the S&P 500, the falls that they've had, that sharp fall that they have, they've rebounded 55, nearly 60%, and they've recouped about 55, 60% of those losses. And so people are really pricing in, a huge dollop of optimism, really. Corporate earnings in the US are poor. Some people are not even giving forecasts out any longer. And I'm not really sure that the stock market really reflects exactly where we are economically, this disconnect between Wall Street and Main Street. And again, as you said earlier on, all fueled by the Fed printing press just going on and on and on.
Nick, we'll leave it there, but thanks for joining us for this week's IG Markets podcast. That was Nick Cawley from Daily FX with a look ahead to Friday's non-farm payroll and beyond.